All right, let's dive into something that sounds like it's straight out of science fiction. Crypto liquidity bots. We're talking about algorithms that promise to trade for you 24/7 while you sleep.
So that's the big question, right? Could a robot really trade crypto for you? Today, we're going to unpack that. We'll go from the simple little helper bots all the way up to the high-speed predators to see what it actually takes to let an algorithm manage your crypto.
But hold on, before we can even get to the bots, we need to understand the world they live in. And that world is built on one of the most fundamental ideas in decentralized finance, the liquidity pool.
So what exactly is a liquidity pool? Well, the easiest way to think about it is like a big shared pot of two different crypto assets, say Solana and USDC. This pot is really just a piece of code, a smart contract, that lets anyone come along and instantly swap one for the other. You don't have to wait to find a buyer or a seller. It's the engine that makes decentralized exchanges like Orca or Uniswap go.
So how do you get involved? It's actually pretty simple. You deposit an equal value of two different tokens into the pool. So if you put in $500 worth of SOL, you also have to put in $500 of USDC. And for doing that, for providing that liquidity, you get a cut of the fees from every single trade that happens in that pool. And sometimes, some pools will even throw in extra reward tokens just to sweeten the deal.
Okay, now for the big catch. The number one risk you hear about, impermanent loss. See, if you just hold your Solana and the price skyrockets, great. You still have the same amount of SOL, it's just worth a whole lot more. But in a liquidity pool, it's different. As the price of SOL goes up, traders are buying it from the pool. So the pool automatically sells your SOL. This means if the price pumps, you actually end up with less SOL and more USDC than when you started. You might miss out on some of those big gains.
And modern liquidity pools make things even trickier. To earn the best fees, you have to concentrate your liquidity in a really tight price range. But what happens when the price moves outside that little window? Well, your position goes completely dead. It becomes inactive. You earn zero fees. Your money just sits there doing absolutely nothing until you manually log on and fix it. And this is the exact problem that our first type of bot was born to solve. This problem of going out of range leads us straight to our first level of automation, the auto-rebalancing bot. This is probably the most common and accessible kind of bot you'll find out there. I love this analogy from the source material. It calls these bots the Tesla autopilot of Orca liquidity. And it's perfect, right? It's not going to fully self-drive your entire portfolio into the sunset, but it handles all those tedious little steering corrections to keep you in the right lane and, most importantly, keep you earning those fees. So how does it do it? Well, it's a pretty simple but really powerful loop. The bot just sits there and watches the price 24/7. The moment the price starts drifting toward the edge of your range, the bot wakes up. It pulls your funds out, does a quick calculation to figure out a new, better range, and then puts your liquidity right back in. It's basically doing all the boring, manual work for you so you don't have to.
And the best part is, you don't have to be a coder to use one. For most people, platforms like Camino Finance on Solana are totally plug and play. You just deposit into a vault and you're good to go. But hey, if you are a bit more of a techie, you can even find open source scripts on GitHub and run your own custom bot.
Okay, so if the auto rebalancer is like cruise control, then level 2 automation, well, that's like hiring a professional chauffeur. Now we're talking about pro market-making bots.
Here's a really cool way to picture this. Instead of just managing one position, a market-making bot is like a robot vendor in a store. It's smart enough to put your liquidity on a bunch of different shelves, or at price ranges at the same time, and it's constantly shuffling everything around to wherever the most customers or traders are.
Yeah, this is way more advanced than a simple rebalancer. These bots are deploying your money across narrow, medium, and wide ranges all at once. They don't just move your range, they dynamically shift capital to where all the trading action is happening, beefing up your positions in volatile markets to suck in more fees.
And the appeal here is pretty obvious, right? You've got much higher potential to generate fees, it's much more of a set-it-and-forget-it kind of strategy, and your capital is almost always active and earning for you. It's like you get to act like a professional market-making firm without having to manually trade all day. But, and this is a really big but, there are some serious downsides. These strategies need a lot more capital to even work well. If you set up the bot with a bad configuration, you can lose money way faster than you would have on your own. And remember, even the smartest bot on the planet can't get rid of impermanent loss. Plus, you're trusting a third-party platform with your money, which is always a risk.
And speaking of capital,
To make these pro-level strategies actually worth your while, you need a good chunk of it. We're talking a starting point of around $5,000 to $50,000 or even more. This is definitely not a beginner's game.
Okay, now we're entering the final level. This is the most intense, most competitive form of automation out there, the high-speed arbitrage bot. This is the big leagues.
And I absolutely love this quote from the source material. It calls these bots hyper-sweaty day traders on steroids. And honestly, I can't think of a better way to describe it. This is a game of pure, brutal speed, where every millisecond counts.
So here's how a trade like this goes down on a super fast blockchain like Solana. The bot is watching prices across tons of exchanges at once. The instant it sees a tiny price difference, I'm talking fractions of a penny, it pounces. In one single, unstoppable transaction, it buys low on one exchange and sells high on another, pocketing the difference. And this all happens in the blink of an eye, in a mad dash against hundreds of other bots all trying to make that exact same trade.
Let's be clear, this is not a space for the average person. The competition is insane. You need the fastest code, the best servers, the lowest latency. If you're not the fastest, you're the loser. It's that simple. Retail bots almost always get absolutely crushed, and the private market for these bots is just filled with scams trying to drain your wallet.
Okay, wow. We've covered the 3 main levels of these bots. So let's bring it all back home and figure out the bottom line. What does all this actually mean for you?
Which of course brings us right back to where we started. After seeing everything from the helpful autopilot to the pro chauffeur all the way to the insane F1 driver, should you actually use one of these algorithms? Well, it really just boils down to your goal. If you're looking for a mostly passive way to earn some yield, then the managed platforms like Camino or Meteora are the obvious choice. They do all the heavy lifting for you. But if your goal is to be a serious professional-style trader, you're looking at a much steeper hill to climb. You're going to need a custom bot, your own servers, and a serious amount of capital to even have a chance.
And that leaves us with one last question to chew on. As all this automation gets more and more baked into finance, are these bots the future of investing for all of us? Or are they just a faster, more complex way to face the same old risks that have always been there? Something to think about. Thanks for tuning in.